Marios Stamatoudis, the 2023 U.S. investing champion, posted a remarkable 291% return in a single year. But what's even more impressive is how he got there. His path wasn't smooth, glamorous, or lucky. It was built on early failures, hard lessons, and a level of discipline most traders never reach. In today's video, we're going to unpack his approach in two parts. First, the real story behind his trading journey, the mistakes that nearly knocked him out, and the turning points that reshaped his process. Second, the exact setups he used to produce championship-level performance, backed by real examples and clear logic. By the end, you'll understand the mindset and framework of a U.S. investing champion, and how those principles can elevate your own trading.
Part 1. The Journey of Marios Stamatoudis. Marios's trading career didn't start with a mentor, a hedge fund background, or a well-structured plan. It began with something far more common: a Google search. How to make money online. Like many beginners, he jumped straight into the markets with no understanding of risk, position sizing, or even basic chart reading. He unknowingly used leverage, and within just 3 days, he blew up his first account. Most people quit at this point. But for Marios, that loss didn't just hurt his wallet, it bruised his ego. And that pain became the fuel that pushed him forward. Instead of paying for programs or gurus, he went in a completely different direction. He joined Facebook trading groups, downloaded traders' past watch lists, and spent over a year reverse engineering trades candle by candle. Every chart became a clue. Every watch list became a case study. His routine became relentless. Wake up, study, trade small, review, repeat.
Over time, he identified recurring behaviors in the market and started building a system based on 1. Historical backtesting, 2. Volume footprint analysis, 3. Patterns around catalyst-driven moves. By 2020, despite good performance, he hit a wall. The constant screen time, rapid reactions, and intraday stress wore him down. He said charts began appearing everywhere, even in the shapes of mountains outside his window. That's when he stepped back, and during that break, everything changed. He picked up How to Make Money in Stocks by William O'Neill, a foundational book for momentum and growth stock traders. Immediately, his approach shifted from day trading to swing trading, from reacting to planning executions, from alert-driven trades to structured, setup-driven trades. And that shift laid the foundation for the setups you're about to learn, the same setups that helped him win the 2023 U.S. Investing Championship.
Part 2. Marios Stamatoudis' Setups. Now that you understand his journey, let's break down the 3 core setups he used to generate outsized returns. For each setup, we'll walk from the theory to a real example, and then the key insight. Setup 1. Episodic Pivots, Catalyst Gappers. Episodic pivots are one of the highest conviction setups in momentum trading because they're driven by new, unexpected information, the kind of information the market must reprice immediately. These catalysts can take many forms: an FDA approval, a breakthrough technology, a newly granted patent, or earnings that come in far above Wall Street expectations. When a true catalyst hits, institutions don't wait. They step in aggressively, creating a surge in demand that pushes the stock into a gap up with explosive volume. And that gap often marks the beginning of a powerful momentum phase. This is where Marios excels. For him, the goal is not to predict the news, it's to react with precision when the cape confirms that something meaningful has changed. If a stock opens with massive volume behind a legitimate catalyst, he enters early to capture the euphoria phase, the moment when attention, liquidity, and price expansion all align.
Real example: Duolingo, DUOL. On March 28, 2023, Duolingo announced earnings that blew past expectations. Revenue came in significantly higher than consensus. Profitability metrics beat forecasts across the board. The reaction was instant. DUOL gapped up sharply on heavy volume, signaling institutional demand. Marios entered the trade around $107 and held the position until price broke below the 20-day moving average, locking in a gain of over 20%. But the story actually began months earlier. After 2022 ended, Duolingo rallied roughly 66% in just 24 trading days, hinting that large players were positioning ahead of strong results. When the blowout earnings arrived, it validated that accumulation and triggered another wave of momentum buying. From a technical perspective, Duolingo spent early 2023 through March forming a classic flag pattern, one of the most reliable continuation structures in market history. And that leads to a timeless truth in trading. There is nothing new under the sun. Patterns repeat because human behavior repeats. Price action, not opinions, not forecasts, is what ultimately pays the trader.
Setup number 2. Breakouts from tight consolidation. This setup begins with a simple requirement. The stock must be in a confirmed uptrend. That means price is trading above the 10, 20, and 50-day moving averages, showing strong institutional demand. But even the strongest trends need to pause. After a sharp advance, early buyers take profits, creating a natural slowdown. This pause forms the foundation of the setup. What Marios looks for is not random pullbacks, it's orderly tightening. The stock drifts sideways, forming a flat base or tight range that can last several days or even weeks. As the range contracts, volume fades, signaling that sellers are drying up and supply is shrinking. When supply collapses and demand reemerges, the breakout often happens fast, and that breakout becomes Marios's entry.
Real example: LUNR. On February 15th to 16th, 2023, LUNR exploded more than 300% in 2 sessions, lifting strongly above every major moving average. Then the character of the stock changed. Price moved sideways for 2 sessions. A clean, tight box formed. Volume fell off sharply, indicating exhaustion from sellers. The moment LUNR broke above that box, Marios took the trade. What followed was a textbook momentum burst. From the open to the intraday high, the stock surged roughly 250%. Even from open to close, it held a gain of about 115%. But the massive upper wick told another story. Selling pressure was pouring in. Recognizing the shift, Marios exited the trade the same day, securing a substantial profit while avoiding the reversal that followed.
Setup number 3. Parabolic shorts. Parabolic shorts are built around one clear condition. The stock must have already experienced a massive, accelerated uptrend, often several 100% in a short period. As buyers chase higher prices, the chart begins to curve upward, forming a steep, parabolic trajectory. This is the point where the move becomes unstable. Marios waits for the moment when that structure finally breaks. After a parabolic run, the first heavy red candles are critical. When a strong decline slices beneath the parabolic curve, it signals that momentum has flipped and late buyers are now trapped. That breakdown is his short entry. This concept isn't new. Over a century ago, Jesse Livermore used the same pattern to short major market tops, famously capturing profits worth about $100 million at the time, roughly $2 billion in today's dollars. The lesson is timeless. When a trend becomes unsustainably vertical, the reversal can be just as violent as the rise.
Key takeaways.
We've now covered the 3 setups Marios used to win the championship: episodic pivots, tight-range breakouts, and parabolic shorts. But here's the most surprising truth. Marios' win rate is only 35%, lower than a coin flip, and probably lower than many people watching this video. So why did he end up outperforming 99% of traders out there? Because of discipline and risk management. He risks only 0.25% to 0.4% of his account per trade. If he had a $100,000 account, that means max loss per trade is $250 to $400. Even a streak of 10 losing trades costs him only a few percent. But one big winner? That single trade can erase many losses and push his equity curve to new highs. This is the foundation of asymmetric trading. Small losses, massive wins. One trade can change your entire month or your entire year.
If you want to learn an asymmetric trading system, one where your upside is many times larger than your downside, then the trading program I've built is for you. On the screen right now are the results of my students, traders who've become consistently profitable, passed funding challenges, and now trade with confidence and discipline. In the past, students paid thousands of dollars to join the live program, but today, I'm making the entire program available for almost free. You only pay $25, about 1% of what earlier students paid. And to be clear, after YouTube's 30% cut in taxes, I barely receive anything. So why not make it completely free? Because when something costs nothing, people treat it like it's worth nothing. But when you invest even a small amount, you show up, stay consistent, and do the work. $25 is the price of a couple of Starbucks drinks, yet it can save you years of trial and error and potentially tens or hundreds of thousands of dollars in trading mistakes. I've opened the door. The only question now is, will you walk through it? Click Join on the YouTube membership program or tap the link in the video description, and I'll see you inside.